Hello students, welcome to all of you Shiksha 360 JAP classes. Today basically we have to cover chapter number 29 of Indian economy part 2. So first of all, I will tell you basically what we have covered in the previous session. We have discussed regarding the basics of market, what is a market, what is financial market, what is price discovery, how we can determine the price. Through this graph, we are able to understand evolution of the financial market and what are the different segments of the financial markets: credit, money market, debt market, foreign exchange, forex market, derivatives market, capital market, insurance market, mutual fund market. Tell capital market we have already covered in the previous session. Now move further, and I have already shared 20 MCQs regarding this one. Today we will share more 20 MCQs so that you can cover whatever we are discussing here directly. You can practice that material through the MCQ in the group. So now we will move towards the next one, that is the insurance market. Okay, all these students who have not attended the previous session, just go through that session. So in an increasingly competitive economy, you know that presently insurance also plays an important part. Okay, so in an increasingly competitive economy, the need for insuring against the risk is well recognized. In India, the insurance industry is broadly classified into life insurance and non-life insurance business. Okay, so in India, the insurance industry is broadly classified into the life insurance and non-life insurance business. In the early days, life insurance business had been undertaken by the Life Insurance Company of India, that is LIC, and non-life insurance by the General Insurance Corporation and its 4 subsidiaries. Now you will see that there are many more insurance companies available in the market of government and of private. Okay. Earlier, basically, there are 2 main agencies. You have to remember, that is for life insurance, that is LIC. Life insurance business had been undertaken by the LIC, Life Insurance Corporation of India, and non-life insurance, that is by the General Insurance Corporation of India. If you have any doubt regarding the life insurance and non-life insurance, so you can comment in the comment section. I will discuss in detail. So in the wake of financial liberalization during the early 90s, the Committee on a Reform of the Insurance Sector, kindly remember this name, who is the chairman of that committee, that is Shri R. N. Malhotra, recommended in 1994 the opening up of the insurance sector to the private participation and the institution of a separate regulatory and development authority. Okay, so before 1994, there is not any permission for the private players to enter in the insurance sector, but after 1994, they have given the permission to basically for private agencies to participate in the insurance sector, and they are also demanded a separate regulatory and development authority. So the result of that, there is IRDAI. So accordingly, the Insurance Regulatory IRDAI and Development Authority Act was enacted in the year 1999, and a separate Insurance Regulatory and Development Authority was set up. Okay. So accordingly, the Insurance Regulatory and Development Authority Act was enacted in the year 1999, and a separate Insurance Regulatory and Development Authority was set up. The insurance sector was also thrown open to the private sector, which opened up the development of India's insurance industry on a competitive basis to meet the insurance demand of a socially and economically mobile society and a rapidly changing industrial sector. Okay, so this is the regarding the insurance market, and what is the important point which we have to learn: life insurance for given basically taken up by which agency, non-life which agency, and chairman of the committee. Okay, rest not that much hard. And IRD Act basically was enacted in the year 1999. Now next one, that is a mutual fund. So mutual fund, it is a mechanism for pooling their resources. Mutual fund, it is a mechanism for pooling their resources by issuing units to the investors and investing funds. Okay, so mutual fund, it is a mechanism for pooling the resources by issuing units. Clear, they will issue the units and you have to invest the fund according to that. NAV, that is net asset value. Okay. So mutual fund, it is a mechanism for pooling the resources by issuing units to the investors and investing funds in securities in accordance with objectives as disclosed in offer document. Clear, basically in which fund you have to invest your money. A fund established in the form of a trust to raise monies through the sale of units to the public or a section of the public under one or more schemes for investing in securities, including money market instruments. Okay. So a fund established basically in which form? In the form of a trust to raise monies. How they will raise money? Basically by issuing the units through the sale of units to the public or a section of the public under one or more schemes for investing in securities, including money market instruments. SEBI regulates mutual funds. Through mutual funds also have a self-regulatory body in the form of Association of Mutual Funds of India. Okay, so SEBI regulates mutual funds. Through mutual funds have also formed a self-regulatory body, like for the insurance sector, IRDA. Similarly, they have body that is Association of Mutual Funds of India, that is AMFI. Kindly remember all these full forms. Clear, sometime in the examination they will ask these types of full form, which is an industry body of mutual funds. Individual can invest in the stock and bond market. They can have trading accounts with the broking houses. There are many more different broking houses and undertake their transactions. However, as the stock market and other financial markets are complex, all individuals may not be able to access the equity and other markets with ease and efficiency. Okay. What is the meaning of that? Many of the people are directly investing in the stocks and some other basically in the mutual funds. Okay. So mutual funds basically are also comprises of the different stocks, but some have knowledge, so they have directly invest in the stocks, and other though that they don't have not that much knowledge, so they will invest in the mutual funds. Here that is a club of the different stocks. So mutual fund further, that is, it is a pool of money managed by a professional fund manager. A mutual fund offers an appropriate platform to the individuals to assess the market. Okay, so a mutual fund offers an appropriate platform to the individuals to assess the market through a plethora of schemes. Plethora, that is plenty of schemes. A mutual fund operates through its asset management company, that is AMC, which employs skilled fund managers to operate in the market and manage the corpus fund. Okay. So a mutual fund basically basically from where it is operates, basically a mutual fund operates through the asset management company, which employs skilled fund managers to operate in the market and manage the corpus fund. A mutual fund, it is a trust that collects money from a market from a number of investors who share the common investment objective and invest the same in equities, bonds, money market instruments, and or other securities. So, okay, so it depends upon then equities, bonds, money market instruments, or other securities. And the income or gain generated from this collective investment, it is distributed proportionality among the investors after deducting the applicable expenses and lavished by calculating a scheme, that is net asset value or NAV. Clear, which I have already discussed in the starting of the mutual fund. Clear. NAV. Clear, that basically through which the units are to be calculated. Net asset value. I think all of you are aware regarding all these things very much. And one question from my side to all of you, kindly mention some of the mutual funds which are growing better in the market in the comment section. Simply, what the process is? Simply put the money pooled in by a large number of investors. It what makes up a mutual fund. So the AMC, asset management company, can launch a variety of schemes with the different types of the direct plans, in which the investor invest directly, and regular plans basically in which the investor invests through the brokers. Yeah, and here broker basically will get the commission on every installment and accepts the subscription from investors. Clear? Here basically in the directly you will get a little bit more return than through the regular plan. Clear? Here the commission will goes to that. Very less difference, but there is a difference. Okay, so different types of the direct plans and regular plans. The money collected in the mutual fund is invested by a professional fund manager in line with the scheme's stated objective. In a return, the fund house charges a small fee which is deducted from the investment. The fees charged by the mutual funds are regulated and are subject to certain limits specified by the Securities and Exchange Board of India. Clear, the fees charged by the mutual funds are regulated and are subject to the certain limits specified by the Securities and Exchange Board of India. Clear, by the Securities and Exchange Board of India. Okay. Hope you are able to understand regarding all these points. How it is work. Next one. So a mutual fund, very, very important. How it can be classified. A mutual fund scheme can be classified into the open-ended scheme and close-ended scheme, depending upon its maturity period. What is the difference? An open-ended scheme or fund or scheme is one that is available for subscription and a repurchase on a continuous basis. That is open-ended scheme. It is like that. They have no fixed maturity period. Clear? These schemes do not have a fixed maturity period. On the other hand, a close-ended fund or scheme has a stipulated maturity period. Like we can say that this fund, it is basically for 3 years or 5 years. Clear? This is the basic difference between the open-ended scheme and close-ended scheme. The fund is open for subscription only during the specified period at the time of launch of the scheme. Investors can invest in the scheme at the time of the new fund offer, that is NFO. You can also hear this word, that is NFO, that is new fund offer. Okay, so investors can invest in the scheme at the time of the new fund offer, and thereafter they can buy or sell the units of the scheme on the stock exchange where the units are to be listed. So in order to provide an exit route to the investors, some close-ended funds gives an option. Clear? So in order to provide an exit route to the investor, some close-ended funds gives an option of selling back the units to the mutual fund through periodic repurchase at NAV related prices. Okay. You can also sell back. Buying, selling, basically when you are getting profit, so you can get sell also. So SEBI regulations stipulate that at least one of the two exit routes is provided to the investors, either repurchase facility or through listing on a stock exchange. Clear? Exit route that is provided to the investor, that is either repurchase facility or through listing on the stock exchange. Okay. So this is the brief discussion of the mutual fund. Hope you are able to understand regarding that. Okay, so we have covered all the things regarding the segments of the financial market. And I request to all of you once again, kindly practice all the MCQs available in the Indian economic group. Now, next one, that is the functions of the financial market. So the following are the function of the financial market. First one, that is the price determination. How we can determine the price, funds mobilization, liquidity, risk sharing, easy access, reduction in transaction costs, and provision of the information, capital formation. So first one here, that is the price determination. So financial markets perform the function of price discovery. Clear? Financial markets perform the function of price discovery for the different financial instruments which are traded between the buyers and the sellers on the market. Clear? So financial markets perform the function of price discovery for the different financial market instruments which are traded between the buyers and the sellers on the market. So for price discovery, we have already covered. So the prices at which the financial instruments are traded in the financial market. How the price it is to be decided, basically we can say that, determined basically by the market forces. Market forces, what are that? That is the demand and supply in the market. If there is more demand, so price basically a little bit higher. If there is more supply there, then there is a little bit less price. Accordingly, financial markets provide the vehicle by which the prices are set for both the financial assets which are issued newly and for the existing stock of the financial assets. Clear? Which are issued newly and for the existing stock of the financial assets. Okay. So this is the price determination. That is basically through the market forces, that is the demand and supply in the market. Next one, that is the fund mobilization. Along with the determination of the prices at which the financial instruments are traded in the financial market, we have already determined the required return out of the funds. Clear? Basically, why you are investing in the funds, that is you will get a better return or profit. So the required return out of the funds invested by the investor, it is also determined by the participants in the market. The motivation for persons seeking the funds is dependent on the required rate of return which is demanded by the investors. Clear? So that is which fund basically, or how much you want to invest. It is basically depends upon the return. Clear? If you will get a better return, so you will invest more, otherwise you will invest less, or you will not invest. It depends upon the return. So it is this function of the financial market that determines how the funds which are available from the lenders or the investors will get allocated among the entities that are in need of the funds, or raise the funds by means of issuing financial instruments in the financial market. Hence, in this manner, financial markets contribute to the mobilization of the savings of the investors. Okay. So basically, this is the saving of the investors. Clear? And why they invested, that is basically to get the better return. Okay. Next one, liquidity. Liquidity, basically how you can get your fund back easily. So the liquidity function of financial market provides an opportunity to the investors to sell their financial instruments at their fair value prevailing in the market at any time during the working hours of the market. Clear? Like if they are getting better return, so they will sell on the spot. So in case there is no liquidity in the financial market, then the investor will have to forcibly hold the financial securities or the financial instrument until the condition arise in the market for selling those assets, or the issuer of the security is obligated contractually to pay for the same, that is at the time of the maturity in the debt instruments. Like you have purchased the bonds. Clear? So there is a lock-in period for that. Clear? This is the thing they're saying here. So thus in the financial market, investors can sell their securities readily and convert them into cash, thereby providing the liquidity. Clear? So thus in the financial market, investors can sell their securities readily and convert them into the cash, thereby providing the liquidity. The next one, that is the risk sharing. Here, financial markets perform the function of the risk sharing as the entities. Clear? Financial markets perform the function of risk sharing as the entities which are undertaking the investments. Okay, which are undertaking the investments are different from the persons who have invested their savings in that entity. Clear? So financial market, that is perform the function of the risk sharing as the entities which are undertaking the investments are different from the persons who are invested their savings in that entity. Clear? So with the help of financial markets, the risk is transferred from the entity which undertakes the investment to those investors who have provided funds for making those investments. Clear? Who have provided funds basically for making those investments. Okay. So try to understand specific this point, that is risk sharing. Even if you have any doubt, then you can comment here. We will discuss in detail that specific point along with one or two examples. Clear? Otherwise, just for the examination purpose, you are able to understand these things. Okay, that is this sharing, that is basically you have to share the risk. That is basically from where, that is who have undertaking the investments are different from the persons that who are invested their saving in the entity. Next is accessibility. That is, industries require investors for raising funds. Clear? That is, companies raise basically issue their share. That is, they will raise funds and issue or lotter the shares to the investors. For raising funds, and the investors require the industries for investing their savings and earning the returns from them. Hence, financial markets bring together potential buyers and sellers, which help them in saving their time and money in finding the suitable investment avenue. Okay. Financial markets, there are many persons or basically agencies which are basically specifically for here to guide you regarding that. Next one, that is a reduction in the transaction cost and provision of the information. Investors require various types of information while buying and selling the securities, and for obtaining the same, time and money it is to be required. However, financial markets help in providing all types of information without the requirement of spending any money by the individual investor. Okay, so in this way, the financial market reduce the cost of the transaction. Okay, so that is a reduction in the transaction cost and provision of the information. Clear, you can get easily all information. Clear, basically in which fund you have to invest, in which fund you have to not. Clear, what is the return of that specific fund? All this information you can easily get. Okay, so we have already covered all the functions of the financial market, that is price determination, fund mobilization, liquidity, risk sharing, easy access, reduction in transaction cost, and provision of the information. Clear? So in the next session, we will discuss some of the questions along with the last topic, that is price discovery and supply and demand. Okay, so in the next session, we will discuss along with that, we have to cover 10 to 15 questions and some previous years memory based questions we will cover. Okay, so thanks to all of you for joining this session, and I request all of you just go through this session 2 times. You are able to answer the question whatever they will ask in the examination. And very important, kindly practice all the MCQs provided in the group. So thanks to all of you for regular session. You can join our Telegram group and email on our email ID, and you can join if you want any course. Clear? So thanks to all of you for joining this session.